Welcome to the Paragon Financial Partners Podcast, where we discuss the markets, our strategies, and how to live better today while planning for tomorrow. Hello, and welcome to the Paragon Podcast. I'm Elean Mendoza, and I'm here with the firm's founder and principal, Evan Shorten.
Hello, I want to thank everyone for tuning into the podcast. I encourage you to stay up to date with our content by signing up for our email updates on the homepage of our website at paragonfinancialpartners.com. To subscribe to our podcast specifically, you can do so on Apple Podcast app or on the Stitcher Radio app.
So, with a lot of the negative sentiment and volatility we've been experiencing this year, we've spoken with many people who are starting to feel a bit nervous and are starting to review their investment portfolios. So with that, we thought it would be beneficial to do an episode on portfolio rebalancing basics. Now, before we dive into rebalancing your portfolio, let's quickly review the basics of asset allocation. When we say asset allocation, we're referring to the mix of asset classes in your portfolio. The three most common and most well-known asset classes are stocks, bonds, and cash. However, there are additional asset classes that don't get as much attention, such as real estate, precious metals, and other more sophisticated alternatives.
It's important to note that with alternatives, there is a wide range of strategies that may encompass anything from currency trading, commodities, even trading derivatives like volatility and risk itself. While some alternative strategies may be available to retail investors through various exchange-traded funds and mutual funds, the most sophisticated strategies are typically only available through private investments such as hedge funds and limited partnerships, all which may reduce or eliminate your transparency as an investor.
So with respects to asset allocation, typically you would figure out your asset allocation through a self-analysis of your personal situation. You would take into account your goals, time horizon for your portfolio, and your willing or unwillingness to accept risk. You could figure this out through answering questionnaires available through your brokerage firm, your employer's retirement plan, or by working one-on-one with a professional. Now, unless you're working with a financial professional, more often than not, once you figure out your asset allocation, you typically invest accordingly, set it, and forget it. And unfortunately, set it and forget is when problems begin to arise. For example, what's one of the things we see most often when speaking with new clients or prospects?
Oftentimes we'll see someone who considers themselves a conservative investor who believes their asset allocation is 30% equities and 70% bonds. However, many times their equity positions are significantly grown beyond the initial 30%, especially during this past decade's bull market. What they thought was a conservative 30-70 portfolio could be 60% equities and 40% bonds, or even higher on the equity side. In other words, their portfolio, which was originally designed for low volatility and capital preservation, may now be very volatile and highly susceptible to stock market fluctuations.
And so this is why it's important to review your portfolio quarterly, or at a bare minimum twice a year, and whenever you have a major life event. If you're working with a professional directly, they'll often meet with you 3 to 4 times a year to make sure everything is in good order. So, Evan, what are some of the ways we can go about rebalancing our portfolios?
Well, the most straightforward way is to simply sell and reduce the size of some of the positions that have grown beyond their original allocation. Then, with those proceeds, you buy or add to the size of positions that have gotten smaller over time. Of course, you want to review each of your positions to make sure you still believe in them and want to continue allocating to them. If you manage your investments by yourself and hold a lot of positions, this could be a bit cumbersome, but brokerage firms often have an online auto rebalance tool. Now, while this may be the most straightforward method to rebalance, you need to be aware of tax consequences. If you're selling positions that have grown beyond their original allocation, you're most likely going to incur capital gains taxes in your non-retirement accounts, meaning you'll owe federal taxes on the realized gains, and depending on which state you live in, you may owe state taxes as well. If you're realizing gains in a retirement account like an IRA, 401k, or other employer-sponsored account, then most likely you'll be free of any tax liability while the assets are sheltered in that account. If you want to potentially avoid capital gains taxes, another rebalancing method is to contribute new money to the underweighted positions. If you can avoid selling positions that have gone up in value, you typically will not be responsible for capital gains taxes. However, if you periodically contribute new money, this rebalancing method may take a while before your portfolio reaches its target allocation, and this has some potential risk associated with it. If you're a conservative investor and your equity portion has significantly grown beyond your ideal allocation, you're highly susceptible to market risk and stock market fluctuations.
Okay, awesome. That definitely covers the two ways most self-managed investors are going to rebalance their portfolios. I'll also add one more thing. If you sell positions for a realized gain, you can potentially offset the capital gains tax by also selling other positions at a loss. However, this is a much deeper issue with very specific rules surrounding it.
Yes, that process is referred to as tax loss harvesting, and we'll have to do an episode dedicated just to that specific topic, most likely in the fourth quarter.
Okay, awesome. With that, we want to thank you again for tuning in. We highly recommend you visit our website and subscribe to our email notifications right on the homepage. We don't spam and we don't send unrelated emails. Until the next time, thanks for listening.
Thank you very much.
Paragon Financial Partners, Inc. is a registered SEC investment advisor. The broadcast is for informational purposes only and should not be considered as a solicitation or offer to purchase or sell securities. The financial strategies and guidelines discussed herein may not be appropriate for everyone, as each individual circumstance is unique. Please review all tax information with your tax professional. Please review all legal information with your legal professional. We hope you enjoyed the Paragon Financial Partners podcast. And again, thank you for listening.